Welcome back to another edition of Pump the Brakes. This is the July 2023 edition. I hope everybody is doing well. And before I go any further, most importantly, please like, share, and subscribe. But most importantly, like the video so that all the algorithms get matched up and this goes out into the universe and more people are able to get this financial literacy that I think is most importantly to everyone, young and old. So with that being said, let's jump into it. It's going to be a brief show. Keep it brief. It's the summertime. I like to say hotter than July here on July the 28th. The old Stevie Wonder album from 1980. It definitely is hot outside, so I hope everybody's keeping cool. That being said, I just want to touch on some economic news that I feel that basically is most important to you. So what's been going on recently? Point one would be the Federal Reserve meeting that took place this Wednesday. That being this is the 28th, so that was the 26th, Wednesday, July the 26th. And it was voted unanimously by all 11 Fed governors. Jerome Powell is the chairman, but there are 11 Fed governors all throughout the region of the United States that come together and talk about economic news and how it's affecting the economy, and most importantly, how it's affecting your pocketbook, so or purse or wallet. That being said, they voted unanimously to raise interest rates again by 1/4 point. So the Fed funds rate, which is the major marker, benchmark for interest rates, or one of the major markers, is now at 5.25. So June, we had a pause, and the pause was just to see the rest of the economic data. But some people will say, hey, to make sure the Federal Reserve is not just trying to slow down the economy way too much, too fast. We have seen the benefits of raising interest rates. It always sounds very weird. You raise rates to slow down the economy. Well, the reason that you do that is because a fast-paced economy creates inflation. That's what we've been living in for, let's say, the past 15, 16 months. So this data comes to you directly from the Federal Reserve, from the meeting, as I mentioned, on July 26th, this past Wednesday. So they raised interest rates. And the most important thing was taking a look at the different things that affect the economy. So that being inflation. The rate of 5.25 on the Fed funds rate, just going backwards, is the highest that we've been in the past 22 years, so dating back to 2001. And generally speaking, as I was just mentioning, anytime that you have a strong economy, the most important thing is to look at inflation, look at jobs, look at what is stimulating the economy, why it's stimulating the economy, but most importantly, if it's really affecting prices, which everybody has complained about over the past, let's say, year and a half. Well, that is why the Federal Reserve raises interest rates to cool it down. I always talk about the Goldilocks story. You don't want the economy too hot. You don't want it too cold. Too cold is usually during a recession. You want it just right. So right now the Federal Reserve is trying to raise rates to cool off the economy. There are some ramifications that come with that. Less spending corporate-wise, less spending consumer-wise, and then of course there are other factors, less growth, of course, but also if you take a look at that, you also have job losses. So that is something with a resurging economy. You have you have more jobs that are created during that period of time. But then when you're trying to slow down the economy, you have job losses and less growth in the job market. So Federal Reserve is taking a look at that. And the reason for raising rates, as I mentioned, that the inflation is still there, as you know. I don't think anybody doesn't know that prices are still higher. I think someone said to me when I was on the train yesterday, it just seems like, prices went up during the pandemic, and they just stayed there. Yes. I always like to say that capitalism, once they know that you are used to something, it is up to you to change your habits, which will bring down prices and competition. Else, otherwise, yes, corporations will maintain that price because based on demand, they will raise prices. So that's another thing to take a look at. The inflation rate came to us. That information came out just a few days ago on July the 12th by the Bureau of Labor Statistics. The inflation rate, also known as the Consumer Price Index, is at 3%. Going back to the Federal Reserve, they like that rate at around 2%. So hence is another reason why they're looking to raise interest rates as they just did. The next Federal Reserve meeting just of interest will be not in August, but early September. So the only way that you'll see rates moving will be in the bond market based on the economic data that comes out between now and that September period. I talked about the unanimous decision. So let's see, if we jump just a little in depth, I'm not going to go too in depth on any economic data, but if I look at consumer spending was one of the reasons, along with consumer confidence, that was one of the reasons for raising interest rates. The Federal Reserve looks at raising rates as being a restrictive measure. I kind of touched on that just a moment, to battle inflation and growth. The good news is that you saw less job openings in the last job report that came out. So that's a positive. It sounds negative, but it's a positive because that means that the raising of interest rates are doing what it's doing what it's supposed to do. So that is good thing. That is a good thing. The bad news is that we saw wage growth still outpacing inflation. Now, again, this sounds very weird. We all want our wages to grow. But if you have higher wages that are growing faster and faster, some consumers or many consumers will then continue to spend and not think about the prices that they're paying. So if we look at wage growth based on the last report that came out, it was at 4.4% year over year. So if inflation now is at 3%, wage growth is growing faster than the actual rate of inflation. Good for you, but not good in the sense of the overall economy and where we want to see things going. So that wage growth report also came to us from the Bureau of Labor Statistics, and that was from the June unemployment report. And if we take a look at the unemployment rate, which stands right now collectively at 3.6%. So let's keep moving. The next thing we take a look at is, so I talked about the CPI, I talked about unemployment, I talked about wages. Next is the growth of the economy, which is very important. And if we take a look at the growth of the economy, we're talking about the GDP, the gross domestic product. That will allow us to see all of the information regarding sales and marketing on the consumer side, on the government side. So that is consumer, government, and corporate side, pardon me. So those are the three entities that you take a look at. And if we take a look at the GDP report, that report came out yesterday, July the 27th, and that rate was at 2.4%. So the total economy grew at a rate of 2.4% versus the previous quarter at 2%. I took a quick breath because then I was remembering, I was telling you guys and trying to hit home a while ago about recession, because we looked at the way that interest rates are aligned right now, whether short-term rates versus long-term rates. And that inverse situation where short-term rates are high and long-term rates are a little bit lower still does exist. We didn't see the recession directly here, but one of our next largest economies, Germany, did have a recession, and they just came out with a report this morning where they eked out of the recession with some growth. So that's a positive sign overall for the global economy. Let's take a look and see. I talked about the rate. You have we look in the GDP report, and we saw increase in spending in housing, utilities, healthcare, financial services, and transportation. So those are some of the areas where we saw the increase in spending. We also saw personal savings go up 4.4 versus 4.3%. So people were saving, of course. And then disposable income was up 2.5% versus 8.5% in the first quarter. So disposable income was less. Savings positive, but the actual income, this goes back to, we talk about wages, wages being up, but the actual disposable income that people had to spend on ancillary things, goods and services, was actually lower than in the first quarter. 2.5% recently in this GDP report versus 8.5% in the first quarter. So 2.5 being for the second quarter. So that's what we saw inside the GDP report. I'm going to keep it moving so we can keep this show running at a quick clip. So if we now take a look at the financial markets, which is important to everybody because that's why you speak to me many times, or that's why you speak, or you look at your investments, you look at your savings, so on and so forth. So if we look at the financial markets as of the close of July 27th, and this data is being brought to you by Market Watch, CBS Market Watch. The Dow Jones year to date up 6.75%. The S&P 500, which is a larger barometer of what's going on in large, medium, and small size companies, up 18.7%. And the NASDAQ, which is a lot more, a larger breadth of companies, had 2,350 of, I believe. That benchmark is up 34.24% year to date, and that's been helped by a lot of growth in technology and a little bit in healthcare, but definitely a lot in technology over the past year. And the Russell 2000, which is a index that makes up the broader market of small size companies, is up 11%. So that gives you an idea of the what's going on in the major benchmarks that we look at on a day-to-day basis. Looking over very quickly, I see the Dow is up right now. The NASDAQ is up. NASDAQ's up nearly about 1% as we speak. Around, what time is it? It's around 10:15. That, which is good, because what we're going to see, if all remains positive, Dow Jones would be up for the past 3 weeks in a row, and the NASDAQ for the past 2 weeks in a row. So that's a very positive thing. When we take a look at the actual stock market, various stock indices. Let's take a look at the bond rates and interest rates, because we're always talking about interest rates in the economy. So whether you're looking at loans for credit cards, for mortgages, for student loans, for vehicles, gives you an idea where interest rates are. So this is brought to you by Bloomberg, right off the Bloomberg terminals, roughly around 8:37 today on July the 28th. The 2-year U.S. Treasury had a yield of 4.88%, the 5-year at 4.18%, and the 10-year at 3.96. So the inverse relationship that I was talking about, the opposite relationship, generally you have long-term bonds having longer yields because there's more risk associated over a long period of time versus shorter yields, shorter terms having shorter yields. But we have the inverse, the 2-year at 4.88 versus the 10-year at 3.96. Usually when you see that, it's the barometer that you look at, it kind of the burden, I forget the phrase. Geez, I'm so terrible with phrases at times, but it is the canary in the coal mine, giving you an idea of what the possibility of a recession. But at this point in time, just referring back to the Federal Reserve, the Fed governor said, hey, they removed from their forecast, them speaking 2 days ago, that the possibility of a recession in the United States. So seeing positive growth for the rest of the year. And you also see that in the GDP at 2.4% for the year, at being the second quarter. So we only have 2 quarters yet to report it. So that is the treasury yields for treasury bonds. And if we look short term for treasury bills, the 3-month at 5.4%, the 6-month at 5.7%, and the 1-year treasury bill at 5.35. So if you're looking to park money short term, there, whether it be in your savings, money market, interest rates are up because the Fed has raised interest rates. So you have options. I like to say you have options. So let me take a quick breather. Quick breather is just to check in to say, hey, this is the July version of Pump the Brakes. Please like, share, and subscribe. But most importantly, click on the like button for this YouTube video so that it is shared amongst the masses. That's all I ask of you. It is free to you. It's free to everybody. But like, share, and subscribe, most importantly. So the last 3 points that I'll touch on would be the economic calendar going forward. In the last few days of July, things of importance, I just have 2 points, would be the July employment, which is the ADP report next week, and then the unemployment report, which let's say the ADP may be on Tuesday or Wednesday, and the unemployment generally is on Fridays, but it is next week. And also factory orders. Factory orders gives you an idea of what's going on, supply and demand for hard goods in the United States, whether they're being bought domestically or also for export. So factory orders are very important. I like to say, I always tell my brother, he has a trucking business, you look at factory orders in manufacturing because he's shipping those goods. If he sees it for a period of time, light load, so to speak, there's not a huge demand, he's earning less on each load truck going out based on supply and demand. So that is that's a key barometer. You could be a trucker, you have your own trucking business like my brother Pierre has, and those are things that he looks at. So sometimes people say, Andre, what's all this economic data? It's over my head. But no, if you have a business, it's very important to you. If you're investing, it's very important to you. If you're going to the store, the CPI is important to you because it's giving you a gauge what's going on, why food prices are up. I'm actually going to touch on that in just a quick second. So those are the things to look at on the economic calendar forthcoming. And things that impact your money, well, corporate earnings are being reported. So that's affecting the marketplace. Gas prices, I think the Western crude, the price per barrel definitely has gone up from where we were about a month or 2 ago. Some of that being supply and demand, the summer season, more people traveling. But a big impact comes out of OPEC, but most importantly, 2 members, or 1 non-member and 1 member, one being Russia, who's the non-member, but has influence over oil prices because they're a producer. And then also the Saudis, they've both cut production. And generally, if the Saudis cut production, other members cut production. So if you cut production, that raises prices. And that's what we're actually seeing a little bit slowly but surely inside the marketplace right now, depending on where you are in the United States or globally. Secondly, global grain prices. So if you hear about the news on what's going on in Ukraine, that affects you at home, affects the global prices. Now, we may get more grain domestically, but the prices are what are called spot prices. So there is a spot price that's kind of like when you look at, you want to see, you're traveling overseas, you want to know what the spot price for the dollar is versus, another currency, that whether it be the euro, whether it be the pound, and I can go on and on and on. But spot prices for grains are based not just on production in the United States, but it's based on the global. So if you have a major producer such as Ukraine not being able to produce or get their grain to the marketplace because of the war that's there, it does affect the pricing. So that's something that may affect your own pocketbooks, but also depending on the companies that you invest in as well. Hence that word supply chain. I talked about oil prices. So heating, it is hot outside, and that affects also food prices. If a farmer or farmers cannot get, their products to market because they're affected by the pricing, they're getting less output because their food is withering on the vines, on the trees, in the ground. That's going to create higher prices overall. So that's something to think about going forward. And also, it's very important when we talk about interest rates, if they're going to be raised again in September, because that relates to inflation. The other thing with the climate crisis that we're dealing with right now is higher utility prices. So I talked about food, higher utility prices, they walk in tandem, so to speak. And if that be the case, you're also looking then at higher utility prices, which can affect inflation again. So in closing, that's all I really need to talk about. Hopefully I kept it under just about 20 minutes. You can peruse through the video, share the video, like the video. Most importantly, subscribe. This has been Pump the Brakes. My name is Andre Beckles. I'm an independent financial consultant. The name of my firm is Harare Wealth Management. Please leave a message on the video if you have questions about the economy, questions about investing. Please leave a message. You have the opportunity to do so. I will definitely get back to you, whether it be in the next video or directly. Until the next time we speak, peace be with you and keep cool. Take care.